Hey, deal makers, and welcome to a show where it's all about financial freedom with real estate. Let's do this. Now, if you're interested in investing passively in alternative investments like multifamily, then check us out. Our investment firm is called Nighthawk Equity. Head on over to nighthawkequity.com and just book a call with us. We'd love to have a conversation with you, get to know you a little bit more, and then share some of our upcoming opportunities that we have as well. And I want to give a shout out to Stephen, who left us a review on the Yellow Book on Goodreads. He says, clear, concise, and comprehensive. Okay, the 3 C's. He says, I chose to read this book and author because my investing partner, my spouse, recommended it. We want to get into the kind of freedom Michael makes seem possible and, more importantly, probable. It so much is. So, Stephen, thank you so much. If you have not read the book yet, it's called Financial Freedom with Real Estate on Amazon. And it's the same title as this podcast. And it's also yellow, just like the cover of this podcast as well. Check it out. It's a great introduction into the world of syndications. And with that, let's shout out someone who has done a deal. First deal maker is Jerry Miller this week. He closed on a 96-unit deal in Garden City, Georgia, valued at $11.5 million. That's pretty cool. And like so many people in this business, he got some education. He built a team around himself. He connected to the right network, got the right support. So if you would like to consider working with us, then schedule a call with us on the educational side. That is themichaelblank.com/call. Just book a call there. No obligation call to kind of explore what it's like to work with us. And that's themichaelblank.com/call. Check it out. So with that, let's bring in our co-host, Garrett Lynch. What's going on, Garrett?
What's going on, Michael?
All right, so we haven't bantered much about the market things. It almost seems like the market has been changing considerably over the last several years. And what's new? What are you seeing out there?
Yeah, so the Fed just announced that it was going to cut rates in September by 25 bips, or it's leading and indicating that way. And the way that it works is you typically see things priced in before they actually make the actual announcement. So you're seeing these things priced in prior, and we feel that early. And so we've already kind of been seeing that happen. And so it's not really a shock. The 10-year treasury went up as high as 4.7 around that in its peak. And now it's somewhere in the 390 range, so 3.9%. And the impact of that is you get a little bit of pressure relief. It's nice to see some retraction, but again, we were raising up by almost 4.5 points in just 18 months. So even a 25 bip or a 0.25% rate cut doesn't really make a big impact in the grand scheme of things. Why is this important for real estate investing in multifamily? Well, having lower interest rates will hopefully help deals happen easier. The other side of that is that you're not having as much distress hit the market yet, and so we're not able to see a ton of those deals out there that are distressed for us to just buy from the bank. They're out there, they're happening, but a lot of them are in the D class areas. So those are usually the first ones to go, are the bad areas, which we don't even buy in those areas. I used to, but there's the reason that happens is there's just a lot of variables that are out of your control, and they're very difficult to manage those sites. So those go first. Then you've got the C, then the B, and then maybe A, and not always in that sequence, but that's kind of how it goes. And so we're out there not really seeing a ton of those distressed products hitting the market. We're seeing people that have made some money on a deal even in this environment, and they're ready to sell, and they maybe have a large portfolio, and they're like, hey, let's dump off a couple of our properties, and we'll put them up there and just make some money right now. So it's an interesting time. I thought there'd be more distress by now.
Well, so I was going to say about that. I mean, we've been talking about more distress as well, and we know there's distress out there. One thing we have seen is we haven't seen any short sales being approved, and so there are super distressed properties where the loan balance is below the value of the property, and the short sales are not being approved, right? So are those then going to foreclosure? In other words, what's in your crystal ball regarding this distress? Because you're right, I was expecting to see a little bit more by now. Is that simply just a matter of time, or was there something else going on?
So I think lenders are working with people. You're seeing that happen quite a bit. There are situations where they're not, and they're just taking the properties back, and they're either holding them on their books or they're turning around and trying to sell them pretty quick. That being said, I mean, there's not we just haven't seen a flood of that inventory. So I think depending on how much time people are getting with their loans right now, I think a lot of the rate caps are expiring this year and next year. I think by next year we should hopefully see some more distress because the likely outcome is that rates are not going to jump down a point or more. And so you're still going to have these elevated interest rates when people bought when they were lower. And as time goes on, that's what's ultimately is going to flush out a lot of the people that don't have time left on their loans. And so we're seeing a lot of assets that are still being held by people. They're holding on for dear life, just trying to make it work to get to the next phase, but they haven't quite given it back yet or short sold it. So next year, look out for more distress, I would say.
It seems like we're approaching the bottom of the market. It's just interest rates obviously affect the price a lot. Interest rates have stabilized now. The trend is going to be mildly down. If you look at some of the cap rate projections, they're also mildly down. If you look at the graph, I just jumped up a lot from very low cap rates way up to the top, and it looks like it's peaking. The projections through 2026 are down from where we are right now, which is probably mirrors the interest rate. So it feels like we're towards the bottom somewhere.
Everybody is scared right now to do anything because they can't really see into the future. We're just starting to get the first inclination of some retraction on interest rates. And so while people are scared, that's honestly the best time to buy, most likely. And so that's why we just closed the deal not too long ago. If you can put a deal together and it's a good deal and it pencils and it makes sense, it's a great time to get in just because of where cap rates are. They're so high right now compared to where they used to be. And that's just a phenomenal place to be as far as pricing goes. What you're also seeing people do is buy properties that have an assumable rate, but they're overpaying for that. And so I don't know if I completely agree with that route, although it can push up your cash on cash returns. You are paying a higher price than you would if you just went to go get new debt. So whatever you can find out there. I mean, you like the assumable game. If you want to go and try to put new debt on a new deal, if there's one that exists out there to buy, I think regardless, it's a really good time to get in if you can.
Well, I think so too. It is. It's definitely feels like it's a good time to get in. The problem is there's a lot of fear in the market. So overcoming that fear, that sentiment, when people are parking money in money market, it's tough. But we are seeing continued strong fundamentals and demand in affordable housing. You can't build any more of it. The population is growing. Well, rents are going to go up. Therefore, prices are going to go up and interest rates are going to go slightly down, which will also push prices up. Also, and this is an important differentiator from 2 years ago, loan to values are considerably lower than they were 2 years ago. Right? We used to get 80% loan to cost 2.5 years ago. Now it's 65% loan to value. You can't finance the construction costs. So the risk profile has changed. It's swung from, you could say, on the higher end of the multifamily risk spectrum to the lower end.
Yeah, that's a huge point. And that landscape has changed completely. The deals that we were doing in 2021, they did have 80% LTC. We're getting a loan from the bank to do the construction. We had pretty high leverage on these deals, and they were variable rate loans with they're short term. So if you look at our last deal we just did, it was 5 years fixed rate. We know exactly what we're going to pay for the mortgage, and our leverage was like 65%. So just a completely night and day shift in risk profile. And then you're getting in at a price point that's a little bit more reasonable than where things were peaking out in March of 2022.
Yeah, so it really is a great time to get into the space. Like I said, it feels like we're getting in kind of ground floor. Reminds me a little bit of 2008 to some degree. So we are looking at opportunities, and we'd love to have a conversation with you if you are. It's a great time also if you're on the active side to start talking to brokers right now, so you don't miss this opportunity that we're seeing as well. So let's speaking of opportunity, let's get into this this interview with Frank Emoyasaka, who's a first deal maker, really did a very nice first deal, and his story is just really amazing. Overcame up a lot of challenges coming into this country, and really has started building a major portfolio. So let's learn more about his story. Now, for me, the things that stuck out about Frank's story is that a realization that the current track you're on, your W-2 job, your business you're running, whatever, Like, you don't want to be in the same spot 5 years from now, 10 years, 20, 30 years from now, right? When you realize that the traditional path won't actually help you achieve your financial goals. I think that's really important when you raise your level of awareness and you start doing something about it. It's very difficult when you're a high income earner because, well, you're making good income, you have a nice house, your family, blah, blah, blah. Why risk it all to pursue financial freedom, right? And I think what you need to do is really develop a sense of discontent around that path you're on. And if you're not have a discontent, then everything's fine. But if you do, then do something about it. And that's exactly what Frank did. The other thing that is very important, this is a key message, is the value of mentorship, right? So he talks about the value of a mentor can be a game changer. Whenever you're trying to do something meaningful in life, could be you're trying to lose weight or do this other thing, really having a mentor or a coach to help you navigate that is super important. And scaling your real estate portfolio is no different. So the value of mentorship, having someone around you that has already done what you want to do, and really thinking about, and this is the cool thing, financial freedom. The reason I like it so much is because it gives you the freedom to start thinking about what lies beyond success. So thinking about a legacy and making a difference. And in Frank's case, he recognizes the wealth he can build in the passive income. And now he's starting to think about his next phase in life, and that's making a difference in the lives of children in his home country, Tanzania. And this just shows how real estate can become a powerful tool, not just for wealth building, but also for impact. So there you have it. Frank's story, I think, is a powerful reminder that real estate investing isn't just about numbers, but it's creating a life you love and making an impact along the way. So whether you're just starting out or you're ready to take your investment to the next level, really remember Frank's journey is a great example of how persistence, mentorship, and a strong why can guide you to success. So keep pushing, keep learning, and investing in your future. Here's the Financial Freedom. Catch you next time.